market views. Okay, so remember we discussed the advent of time, and there's one thing that we said that time is more important in the market than price. In actual fact, time is everything in the market. Okay, and so we can basically see that on the 15th of June we had hit a reversal condition, and we obviously on that reversal condition traded down. Now there are two things that the market is constantly seeking. Number one, it's constantly seeking to take out liquidity. Number two, it's constantly seeking to take out or trade into inefficiencies. So inefficiencies are basically expansions in price, where the market will offer you, buy side, but will not offer you, the sell side. Okay, so there will be an imbalance in the market because the market is offering an expansion to the upside, but it's not offering a balanced perspective in expansion to the downside. And so, the market wants to seek out two things. It wants to seek out liquidity, but number two, the market essentially wants to it wants to also trade into what we call inefficiencies. Okay, that's the general concept. So apart from just strategies in the market, we need to understand what the market essentially seeks for. Okay, so for those of you that don't understand liquidity is basically, the aspect of how smooth, okay, in inverted commas, price can essentially deliver, without hassle. All right, so what basically happens when we speak about liquidity, we speak about understanding highs and low in the market. Okay, so assuming that I've essentially drawn, my high, and this is called an uptrend. So right over here at the bottom, okay, there are people who would want to, sell because the market is essentially going on a downtrend. So we would essentially mark this off as a liquidity area, and this as a liquidity area, and that as a liquidity area. Okay, and that is what we would that is essentially what we would call as sell side liquidity. So in other words, there is volume in price when it essentially comes to these levels, because there are people that are essentially looking at selling when the market hits these particular levels, right? So hence why we refer to this as sell side liquidity, because there are people that would be looking at selling in these particular conditions when it essentially comes to the market. So this is what downward moves will term as sell side liquidity. Okay, and then up here would name this buy side liquidity. Why? Because there are some people that would look at buying, okay, when the market gets to this particular level over here, right? So which is also a structural reference point. So as soon as they obviously expansion to the upside, so because there's volume in price, there's a reason why the market would want to turn around here, and the reason why the market would want to turn around here. Okay, so the market highly delivers on algorithmic perspective. So everything that happens in the market is based on algorithms. Okay, as we know that algorithmic perspectives or algorithms begin to deliver how price is essentially delivered. Okay, so this then becomes very, very important. So what we'd have over here at the top would have buy side. What we'd have here at the bottom is we would have sell side, right? So people looking at selling because we're going on a downtrend, people looking at buying because we are going in an uptrend. But because price turned around at this level, this leaves a level of price, and then there's volume upon this level. So we would call this a level of liquidity, and that as well would essentially down there be a level of liquidity. All right, and this is the same thing for the downtrend, and this is the same thing for the market, obviously looking at meeting consolidating ranges. Okay, so today obviously it's going to be a bit more advanced than the normal sessions, but I want you guys to just obviously to pay attention and just to listen, right? So you can see that 15th of every month in the market there is a reversal condition. Towards the end of the month there is an expansion in price. Okay, the first week of the new month there is a retracement in price in the market, and you can basically see over there as well. Okay, towards the end of the month there is an expansion in price. first week of the month. This is from the 1st or the 3rd to say the Sunday, first week of the trading month. There's always a retracement condition in the market, and we could see that the market traded over here into what we would call this bearish order block, right over there into that particular level, which is something that is very interesting. Okay, and you guys can basically see the same thing over there. So there is an expansion in price reversal condition towards mid-month. Okay, and we trade down, okay, to this particular level, and then what do? We go up, we come down, and then we expand in price. So where I took my trade, I'm not sure if you guys saw in the group, but I took my trade somewhere over here on Friday, and I rode the wave, all the way up today. I think there's also FOMC or something like that. But I rode the wave minutes, but I rode the wave all the way up to the top because I had the understanding. Number one, obviously, I had entered into this trade when it took place because I understood that mid-month, more especially towards the 18th from Wednesday to Friday, would look at this condition in the market, and price on the Friday actually did exactly what I was expecting, expanded to the upside, created an order block, and then continued to expand on the upside. So the reaction on Friday was the market just tapping into this order block. Right now, you guys will remember one of the first lessons that we shared is that if you see that there is an order block, and then on top of the order block there is another order block. For example, this is an expansion of price, so there's a zone over here. Maybe some people will call it the demand zone. Obviously, we'll talk about demand and supply zones when we get to the demand and supply section. Okay, so expansion in price, and then we create another expansion in price over here. Okay, so downward move, expansion in price, and this is obviously based on the 8-hour time frame. And then what did we do? We just traded into it. Okay, so once we have this, and this is obviously called a propulsion block, basically, for those that would want to look at smart money concepts, as I would call it. Okay, so that would essentially be a propulsion block, which is over there, which is an order block that was, so this was an order block, expansion higher. So this is an order block that has traded into an order block. So once you have an order block, and then you have an order block that trades into the order block, this would be called a propulsion block, or rather the second source, right? So sometimes what the market will do is that because it was already collected orders right over here on this initial order block, and you basically see, if I would scroll down to the lower time frames, you'd see that the orders had essentially been collected by the market, essentially tapping into this order block, which would be the green area over there. And then it obviously it expanded here, it came back to collect orders, and then it expanded to the upside. Okay, and which is something that is very, very interesting. And so after it expands to the upside, it comes back and retests this particular. So because it had already come and collected orders over here, there is no need for it to come and recollect those orders. So what it does is that it taps into the propulsion. And for me, this was enough confidence for me to basically take this trade. And obviously looking at that the market is a fractal structure, so it gave me an opportunity, to be able to enter this buy, after FOMC. And I think I was also in this buy. And the reason why I exited here at the top is because we understand that NASDAQ moves in ranges, and NASDAQ is lots of these projects or stocks or currencies, they've got measured moves. So NASDAQ in specific has got a measured move of 250 points. And as I've always discussed before, so it's really keen to obeying structural references, but it's also keen to, obeying, its measured move. So you can basically see why NASDAQ basically turned around over there. Okay, and this was very simple. The reason why NAS looking at turning over there is that you can see that this is a 15,000 level. If I go all the way to the right hand side, you guys can see over there. So this is the 15,000 level. So it tapped into this particular level over there, and then also it tapped into this level over there. Okay, so from this candle's low, right? Which is the 3-drive candle, which is something that we always speak about. So from this candle's low to this candle's high, we've got an imbalance in price. So an imbalance is where, the market will just essentially spool price to the downside and just offer downside, momentum, but will not offer an opportunity for upside. So hence why we call that an imbalance in price. So when the market then begins to tap into that particular level, then that imbalance begins to be a point of rebalance in the market, meaning that the market is essentially now come back to rebalance this. Now, there are two things that the market would want to do. Number one, the market seeks to take out liquidity, okay, which is previous highs and lows, right? That is what the market wants to do. The second thing the market wants to do is that it wants to run to inefficiencies. So whenever there's an inefficiency in price, meaning there's an expansion to the downside, okay, the market will always want to come up and obviously, rebalance any imbalance that we might have basically had in the market. Okay, so because of this huge expansion to the downside, the market will want to trade up and obviously come back to rebalance any imbalance that we had. So why this was so valid is because, number one, we had tapped into the second source order block, which was this one over there. We had already collected orders on the first order block, which is this expansion to the upside, and then we went down, we collected orders, and then we just expanded to the upside. Okay, and this was actually like a very, very beautiful trade setup. And if I can maybe take off my fib, all right, so let's maybe look at taking the fib. I just want to quickly measure from here to here, and you can see how beautiful price basically delivers, right? So 161 would be our first TP, 261 second TP, 361, and the fourth one over there. And you can see how the market basically smashed all these TPs to the upside, which is something that I obviously deemed as to be to be quite interesting. So let me just quickly do this, change this color, and then let's not have the background over there. Okay, and then let's just make this color. It doesn't have to be. All right, cool. So let's just say that this is our levels. All right, and as you can see, guys, this was just a very beautiful price delivery, okay, for NAS. Okay, and the interesting thing is that last week I actually caught this. That other week I caught this buy over here, and this happened exactly the time window that I was looking at was 10 to 11 as per the strategy that I normally teach you guys. So you can basically see that the reversal condition happened exactly to the T, okay, right at this time that I was expecting. So this time was 9 to 10, 9 to, yes, so this was 9. Then the reversal condition happened exactly at 10. All right, so sorry, 10:15, so this was 10. And then so we can basically do this 18th of August still. So that was exactly at 10. We made a reversal condition in the market right over there. And then what did we do over there? We traded into this order block, okay, which was over there. And you could basically see on the 15-minute price just tapped into this order block on the 15-minute time frame, very over there, right? And if you even go to lower time frames, you'll see how the market came down to those lower time frames and just began to, let's just go down and just began to tap into this right, and tap into this particular level exactly to the T. Created an order block. We tapped into, this is actually called a rejection block, by the way, guys. So if you see a candlestick, okay, that is essentially like this, for example, let me just try to draw it. So if you see a candlestick that expands in price to the upside, so let me just make this a bit darker so that you guys can see. So if you see a candlestick that basically does the and this is obviously a rejection candle to some people, and what it essentially does is that it does this kind of thing over here. All right, so this is a rejection candle. So this means that sellers are weak, and because you've got a large, portion of the volume, in this particular candle, all right, you could basically see that, the buyers are essentially pushing this to the upside. So what this basically means is that the sellers try to push this candle down, but then what the buyers did was that they pushed the candle up. And so to some people, this can actually be used as a very, potent strategy when it essentially comes to entry models. So what they will do is that once they see the rejection candle, okay, forming like this, where the market is essentially offering upside, they then wait for the market to tap into this particular level over there. So while the market is going down and it's tapping into this level like that, okay, there is a chance that the market would look at tapping into this level, coming almost to the midpoint of this particular level over there, which is, when we speak about rejection blocks, midpoint, in good English terminology would be called either the mean threshold or the consequent encroachment, of that particular, candle, and then the candle escalating to the upside, which is something that is very interesting. So this obviously would be the rejection candle to, the upside, and this states a reversal condition. So why now the open high low close is very, very important for this perspective is that what you then basically see is this, right? From this candle's open, okay, which is over there. Now I just want to mark this thing off like this, to this particular candle's low, which is somewhere over there. Okay, this itself is called a rejection block. So a rejection block means that there is a change in direction of perspective of market. So once you see a long long wick like this, it basically narrates that market, which in our understanding, it would essentially be, looking at clearing houses and settlements. Okay. Yes, banks have a huge contribution towards market moves, but then the market is highly derived from algorithms, right? That is how it books. So, so we've heard about order blocks, but this is also a rejection candle. So from this tails open to that tails low, this actually speaks of rejection. So some people then want to enter the market when the market taps into the wick, which is this, or a shadow, which is this line over here. Then this is where they would want to look for buy orders, because they know that sooner or later the market would want to hit a reversal condition over there. Okay, which is something that is very, very interesting. So the OHLC values, which is the open high low close of a candle, are very important and they're paramount, because they give us a very idealistic building phase. And what you basically see happening on Friday last week is exactly the same thing. You guys can see over there, we get this rejection candle, which means that now buyers are in charge. And because we understand, how these candles work, I never really explained candles to you guys, but I will explain them so that I can actually give you guys a bit of an upside when it comes to reading candles and when it comes to looking at entry models, right? So you can see that we've got this big rejection candle over there, okay, and an expansion in price upwards. So this creates an order block, right, because of this particular expansion. But then also, what else do you see? You see that there is the market then tapping into this level, not really coming to the midpoint, but getting into this wick, which would then be called a rejection block. So if you have order blocks, but then now the proper terminology for this rejection candle, for it like this, it's called a rejection block, okay, which is something very interesting. And over there as well, okay, so you see the market creating some form of rejection after taking out this previous low, okay, which is what the macro always looks at doing, which is what price always looks at doing, right? So this is something obviously we are now going to be, looking at and discussing, because it's very paramount, when it essentially comes to building your views, in the chart. Okay. All right. Just give me one second. Guys, if you are still together with me, just type 111 on the comment section. I want to see that you guys are still together. Nobody's sleeping, because I can't afford to have anybody sleeping at this particular moment in time. So just type 111111111. Give give that kind of love so that we may see it. All right, guys, lovely. So I see the love, I see the love, I see the love. Keep the love coming. All right. So let's go back. Now, this is basically what we discussed, right? So you can actually build a very powerful narrative by understanding what happens in the market during certain times, of the month. And this also will tell you that the market then is not accidental. The way that it moves, how it books is not is essentially not by accident. Okay. So here's what then I'm gonna do. I'm gonna go to my 4-hour time frame. Now I'm on my 4-hour time frame. Okay. And I basically want us to then take a very deeper dive in terms of what we see the market doing on what we see the market doing on particular days. All right, which is very very interesting. So again, we have established that the market is highly relative to times of day, times of month, and that is how it basically books, and that is how the market basically obviously looks at taking or reaching particular levels that we are essentially expecting for it to reach. Okay, which is something that is very very interesting. So we'll delve take a deeper dive in terms of Tuesday, Wednesday, Thursday, Friday, but there is a condition that the market sometimes will want to meet. So if the market on a Monday, Tuesday, normally there's a bullish move. On Wednesday, Thursday, Friday, it will want to be bearish. If the market is bearish on the Monday, Tuesday, most of the times, or sometimes it would want to then look at bullish perspective on the Wednesday, Thursday, Friday, perspective, right? So or normally on the Thursday, and essentially the Friday. So which is something that is, just to be considered, but don't put, too much thought on that. We will actually, discuss that, but it's also very important to understand, the order flow. All right. So let's get on to the importance of this session. All right. So here, guys, is there are 3 things that are very important in the market. Okay, and how you basically build our narratives and how you build our biases. So today I'm just going to be obviously giving you a bit of an introduction. I'm sure you guys that I've been teaching have heard me speak about the advent of macro perspectives, and that I'm a trader that loves to base his narratives on time. So obviously all of you who are on this call have got access to the strategies that we use. Okay, so institutional numbers, institutional extensions, measured moves, institutional levels, ER candles, institutional extensions with order blocks, okay, which would be a trade that you could maybe hold for a very long time, which is basically what we discussed, the other day. So today I just want to just delve into, something a bit more a bit more deeper than what we essentially got onto the last time, and something that is obviously to your interest. Okay, so there are 3 things that you basically need to look at in the market, right? Number 1, it is the previous day's highs and lows. Okay, that is number 1. So if I go to my daily candle, I want to look at my previous day's highs and lows. Let me just maybe shift this, and I don't want to remove this for you guys' study. So let me just expand this, and then let me take this. All right, cool. So what you guys want to obviously look at, something that is very key, very primitive, and very important in the market, is you want to look at your previous day's highs and lows, right? So why I also took this buy trade, okay, was because we had essentially tapped in to number 1, which is very, very interesting. We are tapped into the low of this candle, and you can see that the low has run out, and then the market, traded back up again. But what was very interesting for me is that over here, okay, we tapped into what we call a volume imbalance. Okay, we tapped into what we call a volume imbalance. So a volume imbalance would essentially be where price jumps and does not open, its open price doesn't open closer to the open price of the next candle, does not open closer to the close price of the previous candle. So if you can basically see on all of these charts where one candle closes, the next one opens next to it. Okay, so I've made this my bearish candle, which is down, and then the white is my bullish candle, which means up, right? And you can see over there, in all simplitude and all simplicity, that where one candle opens, the next candle closes almost. So this is why, institutional levels are so important, because institutional levels are largely based on the the high and the low of the previous day. Now, if you understand where the high of the previous day is, sorry guys, and you understand where the low of the day previously was, you can build up your anticipatory skills.
Your phone is full of vice. This is
All
vice.
right, that can essentially help you to build perspectives and ideas when it essentially comes to relating to market moves. Okay, so it helps you to build anticipatory skills, okay, that can really cause you to enter trades at very significant pieces. So I'm sure you guys have seen that I've got strange entries when it comes to the market. Okay. And the reason why I've got those strange entries is because I understand the open of the day and the high of the day. Those are institutional levels that are so critical when you're building up, your bias, because the market is always going to want to take out a previous high or a previous low. The minute you see that, the low of the day is taken out, then you must look, what else do you see? Okay. Do you see a PD array like an order block, or do you see a PD array like a volume imbalance? So a volume imbalance would be where there's an expansion in price, okay? And this gap over here is where the market just wants to spool to the upside. So it leaves a gap. So this would then be termed as a volume imbalance, right? So the minute the market taps into this volume imbalance, now this volume imbalance is now rebalanced. Okay, and then what do we do? And then we offer, upside momentum when it essentially comes to the market. Now, the market does not move like this by accident. It can't be that it moves like this by accident. How would the market want to tap into this area and reverse exactly from this condition? So already, even if you trade like this or you don't, or you believe in this or you don't, but the market is largely based on institutional operating perspectives. Okay. And when you begin to understand the market based on institutional operating perspectives, then it just really builds your anticipatory skills, and it helps you, to enter trades at the correct places, not chasing. Because remember, when you are a trader, right, it's one thing that we always say: when you are a trader, you are like a sniper. Okay, you are like the person who, you are like a hunter. All right. So let me just give you a particular analogy, and I think that this would be define, a lot of things for you guys, right? Number one, there's one general rule that I've learned in my 6 years of trading. Number one, you don't chase the market. You wait for the market to chase you, right? Number two, when you are trading, you are like a hunter. So what that basically means is that you wait up until your target is exactly what you expected, and then that's when you go in for the kill. So day trading is not trading every day. The problem that we have with a lot of traders and a lot of newbie traders is that, people want to take action now. They want to trade now. They want to make money now. They're not willing to wait for higher time frame objectives. But if you want to really build, your anticipatory skills, to be a lot better in your market, you would want to look at using higher time frames to look for order blocks on the 4-hourly time frame, to look for rejection blocks, breakers. Breakers would obviously be failed order blocks. So it's like a break and retest into those order blocks. Do you guys understand? So that's what you want to wait for. So what is your higher time frame idea? And when you understand your higher time frame idea, then you dig deeper in your lower time frames to see where you can enter the market. Okay, through understanding, maybe are you meeting a reversal condition on the lower time frame, or what are we seeing on the lower time frame? If you can go to Dian's case study, you will see it's there on the group. He did a case study for, I think it was for EU, and I'm also going to be doing a case study as well tonight, based on Nasdaq measured moves, right? But what you can basically see is that on that case study, and he explains to you that the market is fractal. So for those of you that don't know Dian is my advanced facilitator. So he's the second facilitator in charge after me. And then I've still got 4 other facilitators that I've mentored, that teaching crypto and all of that to other groups that I have, right? So yeah, maybe one day some of you can also become mentors in this in this group. So Dian basically explains how the market is very much fractal in its nature. And so how, when you get an idea from higher time frame, the minute you tap into a higher time frame objective, look for a lower time frame entry model. Okay, so understanding the fractal nature of the market is so important. So now we go back to this, because there is just no way that this could become very much accidental. Now, what did I say? I said that the most important thing for you to look at in the market is the previous day's high and the previous day's low. That's the first thing that you need to look at. Okay, what is the high and what is the low of the previous day? Once the high or the low of the previous day, once it is run out in terms of the previous stop, then you can anticipate the market reversing higher. But now, if you can see over here we trade into a dynamic, area, okay, which is, we trade into an imbalance, right? You can see that the expansion of price to the upside, okay, but the market is not offering sell side. So if I can maybe rewind this like this, let me just show you, and I'll just essentially put it here, and you can basically see right over here that there's an expansion of price to the upside, but the market is not offering, downside objective. Okay, so this means that there is buy side imbalance, but then there is sell side inefficiency. Okay, so in order for this move to be properly balanced, the market would then want to what? Trade into this perspective, or trade into this move, so that the market is evenly balanced. Okay, and what we basically, the previous day, okay, taps into that the next day, sorry, and then the following day, what does it do? It then, is willing to go higher, but before it actually goes higher and creates this, it taps into a lower level, okay, which is what we could have expected, because if the market is close to this, it will probably look at taking out the previous day's high or the previous day's low at times before it, does what it does. But this is very interesting why the market comes down and goes here, because on a higher time frame narrative, remember this is the daily chart, we've got the market, trading into a volume imbalance that we are looking at. So if I go to the 8-hour time frame, which is still high time frame, this is beautiful. Do you see that this is an 8-hour propulsion block? So we got onto the 8-hour propulsion block, and this was the order block. Okay, so hence why I always say to people that, it's very important for you guys to basically know that if you've got an order block and you've got a fair value gap or an imbalance in price, once that the market has rebalanced this particular imbalance, okay, it's good and well that you might be looking for a higher objective, but if you've got an order block right over here just below your fair value gap, the market would rather want to look at trading into that order block, because an order block is an institutional idea where the market expands higher, but yet fair value gaps are based on algorithmic moves in the market. It's based on the market feeling inefficiencies. So if there's an expansion of price to the upside, this is buy side imbalance, but then there's an inefficiency in price to the sell side. So what does the market want to do? It won't want to obviously look at just only respecting this inefficiency in price, although that is, a viable, option, but it would rather tap into the order block, and then, look at, expanding to the upside. Sorry about that. Yeah, look at the order block and then look at expanding to the upside. Okay. And I know that there's some people on this call that don't understand order blocks. Don't worry. We will get to explaining what order blocks basically are. All right, guys, are we still together in that? If we are still together, just give me some fire emojis in the comment section. There's a lot that we still need to do. Okay. Today's session might end at 9:30 or even 10 o'clock. So I need us to basically delve into this. If we are still together, just give me some fire emojis, fire emojis. All right, let's continue. Okay, so you guys understand this, right? So what did I just say? I said that what you want to look at is the high of the day and the low of the day. That's important for your notes. Make sure that you write this down. 3 important things is the previous day's high and the previous day's low. These are institutional levels, right? Remember, guys, what I said, like when we enter the market, you can enter the market at the first of the month by just understanding where your previous month candle is, and you can ride the market for the whole month. Remember the strategy that I gave you on Friday? You can just do that and you can ride the market. So it's possible to enter a market on the first day of the month, provided that you had obviously tapped into either this condition or that condition. But as a confirmation of that, you would want to look at the market tapping into this open price, which would be called an extension. So this would be an institutional number or level, high and low of the day, but then the midpoint or the open and the close would be the extension, institutional extension. So what you'd essentially look for as an entry model is the market tapping into an institutional extension level and creating an order block on the institutional extension. Okay, so I'm on the daily time frame, but let's look at this. Let's look at our theory. All right, so we have got this on Thursday, and we had this on Friday. This candle was on Thursday, this candle was on Friday. So I'm just going to mark out, just to backtest a bit, I'm just going to mark out my open, or my low, my high of the previous day. And then what I also want to mark out is my close or my open. Remember, if it's a bearish candle, it opens at the top and then it closes right there at the bottom, right? And if it's a bullish candle, okay, what does it do? It opens at the bottom and then it closes there at the top, which is very important. Okay, so obviously today is going to be very important, guys, for your notes. Yeah, it's going to be very important for your notes. So make sure that whatever I'm saying, you listen very, very attentively. If you missed what I say, just always ask me and I will come back and I will answer you. Okay, now let's go. Now let's look at here, guys, right? So we take out this previous day's low, which is this point over there, right? Well understood. Now we tap into the order block, 8-hour order block, the daily volume imbalance, which is a dynamic area of support. Okay, and it makes sense why we would tap into this, because there was a propulsion block on the 8-hour. Okay, a propulsion block is an order block that is created on top of an order block. In case you guys don't know, so this was the order block over here. So propulsion block, this was the propulsion block, and it's very beautiful how we tapped into. So this was the propulsion block, and we tapped just into that propulsion block. And then over here, we had our first expansion to the upside, which would be a demand zone, or the original order block. So this one would be first source, and then the second one would be the propulsion block would be a second source order block, right? Now, let's look at this particular strategies. Now, what we said is that where you want to enter into the market, you'd want to enter on the extension, but an extension confirmed by an order block. So if you want to really hold powerful trades and you want to really take trades at a very sniper entry, it doesn't matter the time, because I know that there are people that, yes, we are time specific. I'm a time specific trader. I love the advent of time in the market, because, and this is why I always teach about time, and I always say that time is far more important than price. Time is the most important thing, far more important than price, right? So let's look at how this basically books and how this basically works, you know, for your notes, because it's very interesting. So what I want to do is I want to find out if I go to my lower time frames. Remember, this one is the institutional level at the bottom. This one here is the extension of that institutional level, all right? Please, can we go to the previous colors of the candles? No, Ken, we don't need to do that, sir. I don't think there's a reason for that for now. You can clearly see that the white candles are bullish. These candles are bearish to the downside. Okay, so there's absolutely no need for that. All right, so let's go, guys. So then we let's look at going to the lower time frames. Okay, so let's go to the 4-hour. Now look at this, which is very interesting. Okay, after we go to the 4-hour, let's go to the 1-hour time frame. Okay, so this would obviously be you know, the 1-hour time frame, okay, which is, you know, so very vital. And you can remember, I think that on the Friday, if I'm not mistaken, there was FOMC, right? Now, what the market wants to do is two things: run out inefficiencies or run to inefficiencies. The second thing that it wants to do is that it wants to essentially trade, you know, it wants to run out stops. So wants to run out liquidity and then tap into inefficiencies over there, okay? So what I'm going to do, I'm going to go to my 15-minute time frame, because, you know, that time frame has got, you know, a lot. And you can see how, you know, how beautiful this is. Or let me rather delve into the 5-minute time frame, basically. And you can see, guys, how beautiful price delivers, you know, over there, right? So I entered, if you guys remember, I entered the market right over here, right on this low, because if you look at the left-hand side of my chart, we had actually entered into a particular, you know, a very, very interesting, place. I think it should have been a fair value gap or something like that in the market, which gave me, you know, the confidence that we're going to go to, you know, the upside. Okay, so cut the long story short, we run down this liquidity, we turn around, and we confirm by bullish movement higher. Okay, so this here, right, this here gives you a condition that because you're on the extension and you're trading high from the extension, there's a possibility that the market, you know, would essentially want to go to the upside. Now, you guys can basically see over there, which was very, very interesting, right? We had an expansion here on the extension, and the most really powerful, you know, entry models are entry models, you know, from this extension. Okay, so here what happens is that if you had considered to enter the market when it first tapped into this extension, remember I created a low, it went up from this extension, there was a gap over there. Okay, now this was the new day opening gap, okay, in the market, which is called the NDOG. So new day opening gap, the market trades into this new day opening gap, and then it trades higher. Right, so because it invalidates this high over here, it takes it out through a liquidity run, or through a stop run. Okay, so this high is invalidated, so the market trades higher, and you can see that it taps into this new day opening gap. New day opening gap works the same as a lot of times it can work the same as, imbalances in the market, where the market will always want to fill it and then maybe look at going on in the opposite direction, or fill it and then just continue to go down, as long as the market is essentially, filled this. So whenever you see expansion in price, the market will always want to come back and fill it, because there's an inefficiency. Remember, we said that the market want to run through stops and the market will want to run through inefficiencies. And you can basically see over here, right? This is something very interesting. So we had exactly on this particular level over there, right? Initially we had an expansion from here, okay, which was an expansion from this particular level, which is the extension. All right. And we said that the most powerful entry models are entries from extensions, or order blocks on extensions. So you can see that from here, 780 to about 818, this was almost like about 40 pips, if I'm not mistaken. Let me just check. 788 to 18. Yeah, let's say it was almost about 40 pips. So we have an order block, which is an expansion to the upside. This high is taken out in the market. Okay, this high is taken out. Let's look at another high. So let me rather do this. All right. So this high is taken out, and then the market creates, relatively equal highs. Okay. Now, whenever the market creates relatively equal highs, a lot of the time, which is known as a level of resistance, the market doesn't really hold, relatively equal highs. It becomes the next level, because this level is too clean. So the market will always want to, expand from these relatively equal highs, right? So we have a stop run over there, which is what always happens. We come back to the extension. This would have been a very beautiful trade, guys. Absolutely beautiful trade for a buy setup. Okay, so then it gets in, it takes out this high, takes out that high, but here, as you can basically see, we've got a level. Remember, we expanded to the downside. Here we've got a rejection level over there. Okay, this was an order block to the downside, and you can see the expansion in price and how the market just rejected all this area. Okay, and then it comes back, it takes out this relatively equal high right over there, and then okay, and then what does it do? It comes down and right on the extension, it trades higher, and it takes out these relatively equal highs, which is the important, and it takes out this previous high, and then it creates relatively equal highs, which was, the next target for the market to basically come through, which is essentially over here. Right? So relatively equal highs are created, and then we expand lower. Okay, so expand lower because on the left-hand side, on a higher time frame, you had a very a level over there from higher time frame ideas. Okay, let me just check. Yes, so we had essentially traded, initially we had essentially wanted to get into this order block over there. So on the 8-hour time frame, okay, we were essentially looking at trading into this order block over there. All right, so the market will obviously want to seek higher time frame objectives. This is why we saw it do what it did over here. Okay, so sometimes very important to wait. This is why there's a person that says that, if traders would learn to sit on their butt for 50% of the time, that's when they would essentially make money. Okay, which is a very powerful code, because people want to constantly enter the market. They don't want to look at higher time frame perspectives or ideas, but those higher time frame perspectives and ideas are very, very important, because it's what helps them to print money. Anyways, so we come into this extension again, so we trade back up again, expand to the upside, come back down, and then continue to expand to the upside, and then we are in this extension. So we create an order block from this extension. And remember, I said that the most powerful order blocks are from extensions, right? So what do? The order block that was created from this particular extension, because remember, this was just below, but it was also a very nice order block, because it had taken out the low of the day. So if the low of the day is taken out, then you can anticipate, those are very beautiful, guys. Was straightforward, because the low of the day was taken out. Stop hunt on the previous low of the day. It traded into a higher time frame objective because over here we had an order block. Remember, this was where we had our propulsion block or second source order block right over here on this level. We tapped into the second source order block, and you can basically see or what time this basically took place at. Okay, this took place just before 11. Okay, so from 10:50 to 11:10, so just before 11, and then we had tapped into this OB over here, but more specifically there was a volume imbalance. You can see between this low and that high, the market just tapped into this VI, and what did it do? It expanded to the upside, which was so beautiful. But if you had missed this entry, and obviously here you had like a fair value gap between this candle's high and that candle's low, you had a gap over there. The market traded into this fair value gap, but it created another opportunity by creating an expansion higher. This was a been opportunity 2 to essentially got in. So it gave us like literally we had like 3 opportunities to get in. This was opportunity number 1, okay, to get into this market, a tap into this area, realizing that there was a market structure shift. So this high had been taken out. So it gives you, because of this wick, it gives you an idea that we will go higher. So we're changing sentiment from bearish to bullish. And this is what would be known as a low resistance liquidity run. Remember what I'd always been explaining before, that the market does this. So if it does this every time, so if there's price moving down, and then what it will do is that it will then, after it creates the low resistance liquidity run, it will then create the high resistance liquidity run. Basically, what we see over there is exactly what we see the market doing of expansion, and then it creates structure. So where you would want to get in terms of structure, as I've told you guys before, is after you identify a low resistance liquidity run, and then you also just have an idea that after the low resistance liquidity run happens, you're going to have a high resistance liquidity run. So market is tapping into this level, structural level. And then what does it do? It comes back and it taps into this structural level over there. And you can see that it's bouncing off structure, which is something that is very like powerful and essentially profound, because it taps into a structural reference point because of this low resistance liquidity run, and then it creates your structure. So you could have been confident that the market would go to the upside because of this run that it had, to the downside over there. So it gave us literally three entries, right? So you can see, because now we are tapped into this particular level down here, which was, what was this level? This was an extension, order block, okay? And next to an extension, tap exactly into it, buy order, boom, to the upside. We had an opportunity here as well. Market structure shift, okay? Create a fair value, tap in, boom, order block, wait for a market to come back, sort of in a buy entry model. So I entered the market right over here. At the first instance, the market tapped in. This is where I entered the market. I knew very, very well. So I staked my buys. If you guys could see, I staked my buys over there, and they just rode the market all the way up. Okay. And I think I must have closed it, I don't know, somewhere up there. If you guys saw that trade that I took. So I took this trade exactly so when 3 o'clock came and 2:30 came, when people like entering the market, I just, I was just cruising because I entered it long before. Do you understand? I entered it at it was not this one. I entered the first one. This is where I entered the first one. Yes, I entered between 2:30 and 3 o'clock New York time. I think this is where I entered the market. I entered the market right over here. If you guys saw that trade, it was just so beautiful. It was so beautiful. And then it went up, up, up all the way. So I wrote it all the way here because I knew that it came into another reference point over here. You see, so the market is always going to want to come to inefficiencies, and it's always going to want to, come to stops. And, this was just an excuse. FOMC ran out all of this liquidity to this side, and then it just spooled, to the low. Okay. And it came down lower, took out the low of the day, and this would have been an so low resistance liquidity run, anticipatory for upward movement over there. Okay. Very simple to the T. These people don't want to wait. People don't want to wait. People would rather, want to enter trades, but they don't want to wait until their higher time frame narrative or their higher time frame objectives are essentially met in the market, right? So let's continue. Now, what I'm going to say to you guys is very, very important, okay? So let's go back to the way we started. We said that the previous day's highs and lows are very, very important, okay? Previous days highs and lows, number one, that is what you want to look at. What is the previous day high? What is the previous day low? Because that would actually help you to build a very strong, bias when it essentially comes to the market. All right. So that's number one, previous day's high and previous day's low. Okay. So let me all right, so let's see. Okay, it's fine. Let's see if I can't do this. All right, so let's continue from this. So what did I say is important? The previous day is what? Previous day's high, as well as the previous day's low. Okay, that is very, very important. That's the first thing that you guys must understand. Okay, because the market will always want to hover along these areas over there. Okay, so previous day's high is over here. Previous day's low is over here. This was on Thursday, basically. Okay, and you can see that the market ran out, boom, tapped into an order block. This was also specifically a volume imbalance, and it escalated higher to that side. So from a higher time frame perspective, this is what we would have been waiting for. This is what we would have been waiting for. And then the trades that would obviously have taken are trades on the extension, okay? And according to our strategy, this would be a sell area, this would be a buy area, and then this would be a confirmation of a buy, which is the first extension, and then this would be the confirmation of a sell, okay, which would be the second extension. Now, if you create an order block on extension to the downside, then you must know when you come into that order block that is formed from extensions, it's game over. Now, what would happen is that a lot of times when you do that, you can essentially ride the way from here all the way to the top, because that's how it's going to move. Or if you enter here, you can ride the way from here all the way to the bottom, which would give you like over 300 or 400 pips. That is how sometimes we begin to hold on to specific trades by taking trades on those extensions. But on the extension, what you want to look for is you want to look for an order block that is formed on the extension. So previous days highs and lows, very important. The second thing that is important for building your bias is session highs and lows. Okay, now you guys know that we've got 3 trading sessions. Okay, so we've got the Asia session. Okay, number 1, we've got the London session, number 2, and then number 3, we have essentially got the New York session. All right, now why you want to note that is because that also gives you direction in terms of where price is likely to go to. Okay, so number 1, previous highs and low, previous days highs and lows. Number 2, session highs and lows. What was the London session high? What was the London session low? What was the New York session high? What was the New York session low? Okay, and you also, the third thing that you want to look at is that you want to look at your 3 days highs and lows. So what was your high and low for the past 3 days? And also, what was your previous weekly high and low? Okay, so let's do this as an example. Okay, remember I said that today's class is going to be a bit more advanced, so I'm just giving you introduction to what we're going to be doing today. So let's go. Are you guys still with me? Are you guys still with me? Are you guys not bored or irritated? I know some of you guys can be like, Ash, this one. When are we stopping? Are we still okay? If we're still okay, just give me 5 emojis in the comment section. Let's see if we are still okay with you guys. Okay, guys. So the information that I'm giving you guys it's the most important thing yet. Okay. It is the most important thing yet. So the only thing I'm gonna ask is that you may go through this session over and 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 over again. All right, so previous days highs and lows, session highs and lows, 3 days high and low, and then previous week high and low. So I'm going to do that now on my screen. And I'm saying this because this will help you to build a very strong bias in terms of where price is likely to move off to next. And this is apart from the measured moves and apart from some of all of these strategies that I've taught you guys in my mentorship. Okay. So let's go. So number one, previous days highs and lows. High of the day, low of the day. So I'm considering Thursday, assuming that we were on Friday. Okay, that's number one. Previous days highs and lows. Number two, what you want to look for is previous session highs and lows. Okay, so let me draft up my session. If you guys don't know how to draft up sessions, it's actually very basic. You can go on to, let me just help you guys out and just remind you guys how you can draw your own session in case some of you might have forgotten. All right. Okay, cool. So what you would essentially want to do is you want to, in case you've forgotten how this is done, but I know that you haven't forgotten, but I'm doing it even for those that are new. So you'd essentially want to go onto you type baby pips, okay? Baby pips on your Google account, trading sessions, okay? Baby pips trading sessions, right? And then you have the Forex trading sessions and the Forex market hours, Forex market time converter. You would want to click onto the Forex market time converter. So what this does is that it helps you to, put your sessions in order, right? So you've got the Sydney session, Tokyo, London, and New York. We don't normally use or trade the Sydney session, although it is a session that basically exists. The top 3 sessions that we have in existence is the Tokyo, London, as well as New York. Okay, now based on your time, where you are in the world, you can obviously adjust your, your time zone. So because I don't see Johannesburg over here, I know that we are in congruency with Berlin, which is essentially GMT plus 2. Okay, so if you are in South Africa, it's GMT plus 2. If you are in London, it's GMT plus 1, because I know that our mentees in this group are from all over. We've got even guys from New York, Johnny, we've got Joseph from Haiti, so we've got a few guys even on this session from overseas. So what you'd obviously want to look at as far as this is concerned is GMT minus 4 would be New York. Okay, so if you are on New York, these sessions will be based on your local time. All right, which makes things so much easier, so that you don't have to like go to indicators, but you can actually set this thing up for yourself. Mumbai, Dakar, Singapore, Tokyo, Sydney, wherever you are in the world, these are your time zone. So I can't see Johannesburg, but I know it's we are on +2, okay, because the time is now 9:17 here in South Africa and Saturday 9:17. So it's very much congruent to what we see on the New York. So now we go to Tokyo session. So when is the Tokyo session? Tokyo session is from 2 a.m. on my local time to about 11 a.m. right? So I'll go to Trading View, okay, and I want to essentially look at drafting this, right? So I'm back on Trading View, and what did we say? When is the Tokyo session? The Tokyo session is from 2, okay, so I'm going to maybe do, so I want to go to the lower time frame, like 15 minutes, so I can be able to draw it properly. Okay, so I say it is from 2 on Thursday, or let me make it on Friday, which is fine. It's from 2, which is here, to about 11. Okay, from 2 to about 11. So this is 11 a.m., right? So this would be the Tokyo session. Okay, so because I already had this as a template, I'm going to go to Tokyo Open. So this is where the Tokyo session begins to open. All right, so Tokyo opens over there. And then we've got the Tokyo close, right? So Tokyo closes exactly at 11. All right. Now, obviously, as you know, I've taught you that Tokyo is consolidation. Okay. And then what would happen is that London, or when New York is a continuation of London up until 2:30 plus, where the market looks at manipulating. So this would be accumulation, and then there would be manipulation to the upside 2:30, and then there would be distribution to the downside after 2:30. So hence, if you do trade news, which I don't prefer, it's just manipulation and distribution. So then the events that happen after news are always great. You see this event after all this sell side has been run out, expansion higher was greater than this manipulation during the news event. So it's never worth it for me. Okay, but anyways, some people trade news and they killed FOMC. Well done, but for me, I don't ever look at trading news because the moves after the news are always much greater. So I don't see why I should risk my account for just a couple of pips that happen during news, whereby I can wait until all liquidity has been run out, which is what the market will want to do, and then trade into my and then come back, run off liquidity, and then I look for reversal conditions. Okay, so according to what I saw, so this is Tokyo open, Tokyo close, and then I go back. Okay, I'm just teaching you guys. Obviously, I know how to do this. I've been doing this now for quite some time, but for those people that don't know, so 2 to 11 would be Tokyo according to my local time, and then I'll come back to this. Then what do I see? London, okay, is from 9 a.m. to 6 p.m. in my local time because I'm on GMT +2. Okay, 9 to 11. So I'd go back and then I would look, where's 9 o'clock? 5, 6, 7, 8, 9. So 9 o'clock is here. Okay, so this would be the London Open session, which would essentially be at 9. And then 11, or 6, sorry, which is over here, which would be the London close. All right. London close session, which would be over there. Okay, and then this is what we have. And then now we've got, let's see, we've got the New York session. So the New York session is between 2 p.m. South African time to about 11 p.m. South African time. Okay, so what do? We come back and we say 2 p.m., which is obviously over here. 2 p.m. South Africa time, which would be the New York open session. Okay, New York open session, and then we have got the New York close session, which is over here, 2 to 11. New York close session over there. All right. Okay. So I would maybe want to write this as New York close. I've already got this template, so it's fine. New York close session for me. And then I want to mark off the New York midnight, which is at 6 a.m. my local time. So New York midnight would essentially be over there. Okay, so this would be New York midnight. All right. So why I write these is because remember what I've always been saying to you guys, that time in the market is more important than price. Time in the market is everything. Time in the market is essentially everything. Okay, so now let's go back now, right? Okay, so now we can see that I've got two lines over there, which was my previous day's high on Thursday. Okay, and this was Friday, and then this was my previous day's low. Okay, so normally when we enter on extensions, okay, which is, this would be where my extension is, price would normally want to come from the extension and trade all the way to the previous day's high before it looks for a reversal condition. And even here, okay, this also came from, you know, an extension and that other day's low, where market traded from all the way to the top over here, and then it came down all the way to there. All right, so by just understanding extensions, there's a possibility that the market could just continue to rally to the upside, more especially now considering the fact that we are heading towards the end of the month. So what happens in the end of the month? There's an expansion in price movement. Okay, that's what happens at the end of the month. There's an expansion in price movement. Okay, and you can basically see how the market took out the previous low, went up, obviously stopped out, very powerful entry model, came back in, and you know, it's offering upside. And I'm sure because this had been violated over there, which was an order block, basically, it's going to look at going to the upside, I believe. Okay, possible upside. Like, okay, cool. So let's get the party, let's continue. So previous days highs and lows, very, very important in the market. And then we've got session highs and lows, which are these sessions. Okay, where you can look at the market essentially looking at going. That's why I actually do these sessions for you. Okay, so in the Tokyo session, what was the highest point in the Tokyo session? This was the Tokyo high. Okay, and where was the lowest point in the Tokyo session? This I would suggest, so from here to here, this was the Tokyo high, as was the Tokyo high, as well as the London high. So I'm just gonna maybe look at changing color, and I'll obviously tell you why that is you know, very important in the market. Okay. Smart. So what the London, no, this was the Tokyo high. Okay, so was the Tokyo high, and this was the low. Let me just maybe put it over here, and this was the right over here. Okay, so this was the Tokyo high, and this was the All right, so let's just wait, guys. I'm disconnected from my other mobile device. Let's just wait to get into this one over here. There we go. I'm back. yet once again. I love Gem Golding's profile picture. It's lit. It's like he's going to slay the markets. All right. So we said one thing that is important, number one, previous days house. Okay. So we had this high over here. So let me just make the previous days highs and lows at least 2x 2x. Okay. So this was the previous day's highs and lows. And then we do the session highs and lows. So this was the Tokyo, London low and high. So here was the London and New York high. Okay, as you guys can basically see. All right, let me carry on. Sorry about that, guys. I think my network is just fighting for me to not to share. Very big problem. So, but I love the fact that I'm connected to two devices. So, all right, so let's continue going. Remember what I said. Okay, first thing that's important is the day's session highs and lows. The second thing that is important is the day's highs and lows. Sorry. So this was the previous day's high. Thursday's high, as you guys can basically see over there, right? So Thursday's low, and you can see over there this was on Friday. So Friday started from this total session. So all of this was from Thursday, yeah, from that particular low, which was over there, which is quite interesting. Okay, so if you tap into a previous low, and also you've got like a very good like higher time frame perspective, like fair value gap order block, then it gives you very good anticipatory skills for essentially going high. In actual fact, it's sniper entries, and you can, guys, you will literally obliterate prop firms. You will obliterate prop firm challenges, right? So low, the Tokyo, same thing, and then this was the high of the New York, and this was the low of the uh, New York and okay, of London, basically, right? So you guys can basically see over there that this is so beautiful. And for you who don't know, there are session overlaps in the market where London and New York opens at the same time. So you can see while London is open, New York is also still open. Okay, so this is a session, the second session overlap. The first session overlap is between Tokyo and London. So when London is open, Tokyo is still running. This is why we have expansion in price over there. Okay, after New York midnight. All right, and you can basically see, and I can tell you why this is happening, but I won't tell you movements during, so that the more volume in the market is between these you know, sessions, basically, right? So because you created the low of the London and the Asia, and you can ranges that you can participate in the market. Okay, and a lot of times when you participate in dealing, tap into the previous session high and low, or maybe you know, it if it doesn't tap into the low or the high, when it expands from that high, it will essentially retest and maybe continue to expand, you know, higher. Okay, so this gives you a very good dealing range. You know, previous session high good dealing ranges when it essentially comes to you know, your market moves, but you're obviously gonna get in like a lot of detail when it essentially comes to this, because I want us to get to the intermediate dealing ranges, but I also want us to get to the dealing ranges. So a lot of those DR or dealing range perspectives are, you know, most necessarily occur on previous highs and lows when it essentially comes to our market moves, right? And how these markets basically book. Okay, so this is well explained because the market expanded on the New York Open, as you can see. So there was first manipulation to the downside, and exactly at half past, we escalated to the upside. But why the market, you know, responded upon this area, okay, because this was the Asia high. Do you understand? And it taps into the Asia high, and then it continues to expand, you know, at a much larger range. And even this one over here, it does exactly the same thing. Okay, as you guys can basically see, this one comes to this low. Okay, the low takes out the low of the Asia session. Okay, and it just expands higher. Now, where's the retest? The retest is essentially over here, would be Asia low, right? And it's really intriguing how the market would react upon these areas. And you see it does. It comes back into this area. Order block was created over here, which this would have given you a very, very beautiful model, was on the X. It was on the extension, basically, right? But we trade this tapping into what? This is tapping into Asia. So this is previous session, right? So you get then to understand that it's not accidental why the market moves the way that it does. And so you your intermediate dealing range session high, so meaning your dealing range would be at the high of the previous session, and then your intermediate dealing range would be at the open, okay, of that. And if we can, you know, basically move from here to here, right? And then this is why there was a reaction over there. Obviously, block, but we've also got a previous session highs and lows. And again, over here at the bottom, okay, it works exactly the same way. So once you have your low over there, you look out for your open price, which is this holding range. And you can see that you tapped into this from this week, and then you expanded. So this was dealing range. This was dealing range at the bottom, and then at the open price of that candle, you had your intermediate dealing range. Now, right there at the top, then your intermediate dealing range would essentially be where the market opens here. So this is an intermediate dealing range. So if we are expanding to the downside to collect orders, we are going to probably be looking at the previous session Tokyo low, and you know, this would be obviously what this would be an expansion to the downside breaker block, a bullish breaker. So it didn't respect it, okay, and this expansion, it just expands and lows. You can begin to derive models in your trading that is is largely based on mathematical perspectives. Now, what this does is that it helps you to basically the same process that goes understand previous highs and lows. You understand the market is more likely to move because you've got dealing ranges and your intermediate dealing ranges. So it changes ever. So even if you get 50% you can still be net profitable. Even if you got 25%, because all you need more that works, and all you just need to do is just repeat and repeat and repeat, and that's how you looking at trading models. Okay. So let's then continue to move. Okay. And then the third thing that you want to basically look at, the previous week high and low as well, because those actually gives you a range that you can possibly look at dealing with previous week high and low as well, right? So what was the previous week's high, what was the previous week's low, and that basically gives you a narrative that you can look at dealing with. All right. If we are still together, guys, give me some fire emojis. Let's get this party running, guys. Let's get this party running. Interesting enough. So are you guys still together with me? Are we asleep or are we good? Are we asleep or are we good? All right. Let's see the fire emojis. Let's see the fire emojis. Let's see the fire emojis. Fire emojis. All right. You know what they used to say to me, guys, right? Which is so funny. They said that the more you know, the more you find out that you don't really know. The market doesn't need anyone that's cocky or arrogant. It needs someone that comes as a student. But it's very interesting. That's what I learned even in the earlier stages of my trading. Like, shoot, the more I know, the more I know that I really don't know. You understand? So you need someone that is going to, be very humble and just continue to learn and learn and learn and learn and learn. And I've been doing this thing for the past 6 years, and I and I'm still learning. I never stop. It's yeah. So, but obviously, yeah. So the more you know, the more you find out that and then the second most important thing is what is your previous sessions highs and lows, because they give you a dealing range that you can basically have in the market. So obviously I've got all my sessions here and what I do previous days high and low. Number one, that's what matters. So I'm on 15,378. Okay, high. Okay, and then one was my previous day's low. So yes, this was my previous day's high. That was my previous day's low. Okay, and I spoke about the fact that when you have your charts like this, then you can see where the market basically reacts. Okay, it reacts upon this was when there was a Tokyo high, and the bottom was the Tokyo low. And you can see how if the market is expanding, it just, breaks out retest of this previous session high, and then goes higher, and then comes down, reacts upon this area. So it's literally reacting upon the highs and the low Tokyo session, or Asian session, which is very, very interesting. And then also I said that your high point would be your dealing range, and where this body opens from this week, this would be your intermediate dealing range over here. Okay, for this New York or London basically was, all right. So London is obviously, still open, and this was the New York high, London high, New York low as well as I think London low as well. And it's a very good idea in terms of where the market is likely to go to. So we tapped into this week because we tapped into the intermediate dealing range. Okay. And market on the low, and then it just escalated to the upside. So where we are reacting over here, we're reacting towards Asia high and Asia low. So first thing that's important is daily highs and lows. Second thing that is important is then what you look at. You want to look at the previous week high and low. So what was the high and low for the previous week? So what you'll do is that you'll just simply go to the weekly time frame. And when you're on the weekly time frame, you just want to see what was the high and low for the previous week. So the high for the week is over here. So I'll just make it white. So this was the previous week, and I'm looking at this weekly candle, and this was the low for the previous week over here with the previous day, and then we've got basically the high and low of the previous that we have, and it's very notice around the area. So this is the really high low. Then you've got intermediate dealing ranges, which is the sessions previous session size early systems to viewing your charts, and great probability when it comes to viewing the markets from a probability excellent trading perspective. And you can easily see, right, this was the time, but and so interesting how we just by trading the previous week's high and going to the upside, you could essentially create a buy Okay, so this is what I want to start off sharing with you today. And what I'm going to do is I'm not going to carry on from here, because I think that this has been a lot of information. So I'm going to stop over there, and I'm just going to give it to you for your time, or for you to begin to think about. Okay, but guys, understand that the market is always wanting to explore liquidity and inefficiencies. Okay, so always wanting to take out buy side or higher levels or lower levels. All right, so previous highs, previous lows are very important. That's why I mark session highs and session lows for active. So where is your dealing range that you are looking at the market doing? That's all based on previous session highs and lows. So the market will always search liquidity. It will always want to look for inefficiencies. Okay. And then what we are going to be, what I want you also to understand that, in all the markets and how the market basically operates is that the markets work harmoniously. That's why I largely say that it is based on a state of algorithmic delivery. Okay. So the markets work harmoniously. Okay. And if there is no harmonious operation of the market, there will always be a crack in correlation. So if there's a crack in correlation, it then basically allows you then to understand the market from divergence perspectives. So if there's a crack in correlation, then you already know that if one is going down, the other will be going up, which is, using the advent of the smart money tool and then coming through to understanding smart money reversals and these particular perspectives. Okay, so note how important what I've said is and how this basically gives you time narratives and what you need to look for, right? Now, the last thing that I'm going to say, when you understand dealing ranges, one of the most important things that you're also going to have to understand is I'm thinking I'm on London here. So the 2 to 11, yes, midnight is 6. This was supposed to be midnight at 6. London opens at 9. Okay, and then it closes at 6. So this is all okay, so it closes at 6. I was on plus 1, guys, over there. So this is 2. Is this 2? No, this is not even 2, eh? So 2 is over here. So this is 2. Tokyo closes at 11, not 12. That's it. It makes sense. Okay, 11. And then London at 9 to 6. Night, New York is at 6. So I'm just doing this in my local time, but I showed so baby pips. And then this one is from 2. And then it closes at 11. Okay, closes at 11. 55. So let me just do this. Beautiful. Lowest Tokyo 7. London basically opens, which is that low, which is fine. And then there's a high. Okay, London closed. London and New York, they've got the same high, which is okay. And then they've got the same low, which is there. All right. Okay. And then the last thing that I'm going to say to you guys as I end of today's session, and then I'm just gonna open it up for anybody that has important times that you also need to understand is the New York lunch, or towards the New York lunch, okay, which is based on time narratives again. New York lunch would be from my local time, 6 to 7 in my local time. So New York lunch 6 all the way to 7 on. Now, here's one thing I want you guys to understand. Okay, that towards the New York lunch, the market will do 3 things. Okay, towards the New York lunch, which is over here, the market will look at reversing as it did, came into an order block just on the New York lunch. Number two, it will look for running for liquidity. So understanding obviously bias. Okay. So this would be a run of liquidity to this side. So taking out this previous low and coming into, this particular order block. So it will either reverse towards the New York lunch. There will be a reversal condition. Okay, that will happen before the New York lunch. And then also the market might possibly look at consolidate, or the market might possibly look at running for liquidity. All right. And why the market would basically want to look at doing these things. So normally, guys, after I set up my local time, I always want then to go back to the New York. So after I draft my things, I always want to go back to New York. Okay. Now, the reason why there is reversal conditions in the market between 10 and 11. This is because what you need to understand is that this reversal condition happens at what I would call the height of going towards the London close session for Forex. Okay. So this is why if all of this liquidity is run down to the left and we're looking at the 10 to 11 window, the market does this. And then on this node, to come up and run down all of this liquidity here, internal and external, sorry. And this would create a very structural point, a low or high resistance discussion for today. If you understand time and you understand highs and lows of days, highs and lows of sessions, highs and lows of weeks, you can create a very strong bias in terms of how the market books and how you analyze what you want to see in the market. Okay, so I'm done for now. Thank you very much for your guys' time, and I wish you the best. So I will open up the next 10 minutes for questions or for comments, and then we shall meet up tomorrow. There is no time. Hopefully this week we'll be able to have sessions from today all the way to Sunday. All the way to Sunday, guys. This is the year that you don't have. This is the time that you guys do not have. Okay, so I'm going to be working very, very hard to be giving you guys information starting from Monday. Remember, the seasoned traders, I'm going to help you with a video of how to start your FTMO trial run. I'm expecting all of the guys that are trading ready to start the trial run. I want to begin to see your progress. Thank you. So let me open up for comments or questions, and then we can end this session for today. Thank you. All right, sessions will be sent to the group. Don't worry, my king, as always.